This is TreppWire Week in Review for week ending December 30th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, a shortened holiday week, had investors sizing up the year and what's in store in 2023. In economic data, last Friday, the Fed's favorite inflation gauge showed it is slowing. Housing data highlighted a sector that continues to cool as pending home sales fell more than expected and home prices have pulled back. Manus, I got to say, it's hard to believe it's the last week of the year, but here we are with some of our own thoughts about what's happened this year and prediction for what's to come.
Yes, we're looking forward to getting into what were the pleasant surprises of 2022. We're not looking forward so much to the unpleasant surprises, to remind people of what took place last year, and for several of us to give our insights into what we think may come in the new year. Before we get into that, we'll talk about the tone of the market over these last 2 weeks or so, very briefly, before we get into this very special episode of TreppWire. The tone of the market remains quite negative, kind of across the board. For those that watch Bloomberg or CNBC or any of the financial network television shows, or listen to Bloomberg Radio or so forth, read the Wall Street Journal, we've had several more down days than up days over the last couple of weeks. The down days have been quite painful in some cases. The sell-off has been broad. The indexes have kind of gone lower across the board. Tech, once again, is kind of pulling up the rear when it comes to underperforming the other indices. So that hasn't changed over the last 2 weeks. It is corresponding to a stretch over that same period of time where interest rates continue to edge higher, especially at the long end of the curve. The 10-year is now back nipping at 4% again. It had gotten as low as about 3.4% at one point. So that's been sneaking up a little bit. That has had something to do with the negativity. On the lending front and the issuance front, the pace at which things are happening is quite slow. We've seen almost no CRE CLO issuance in Q4. I mean, I think there's been one or two, but it's been really negligible. SASB and conduit issuance has been quite light. Predictions for Q1 2023 are muted at this point. They're not zero, as they have been in a couple times in the last couple of years, but they are light. And as far as the crystal ball goes, I would say that the predominant sentiment right now among financial analysts, traders, investors, whether it's in commercial real estate or in the broader U.S. economy, is that the glass is certainly half empty right now, that we are headed for a bumpy H1 2023, and that is driving a lot of the market moves right now. There isn't a lot of optimism. Normally this time of year, we get that so-called Santa Claus rally. There's been really no hint of that over the last couple of weeks. And so we head into 2023 kind of in a period of malaise.
Yeah, so with that, Manus, of glass half empty, it's not really the TreppWire MO to have that outlook, but I would agree with you, the broader market at large does feel that way. And I think everything you covered, I mean, it's an interesting year if you're looking back. I mean, we're on the heels of the pandemic where there was, lockdowns at an unprecedented scale. People were trapped in their homes and working from home. And, the government, I think, took decisive action and tried to keep the markets afloat and keep, people feeling like there was still optimism in the marketplace. And we're dealing with some of the side effects of that decision now with the higher inflation, gas prices. There's some geopolitical stuff and some instability across the globe that I think have really played out in real time in 2022. So it's interesting as we kind of head into the end of the year for us. There was an article this week in Barron's, I think it was also on Market Watch, where, basically just 5 trading sessions accounted for more than 95% of the S&P index losses in 22. So co-founder of DataTrek, Nicholas Colas, described these 5 worst trading days as 5 days that killed the year. So it's kind of interesting, the headline number at year end could be negative, but if you dig a little deeper, really 5 days, and those 5 days being so large in the swing really make the overall number not great. So it's interesting when you look at it from that perspective. I think there's just some things more recently with regards to like retail. There was some optimism at the beginning of the year that the supply chain issues that we've been facing have been remedied, but then inflation creeps in. And so now that retailers have inventory, people are starting to spend a little bit less, or the cost of goods are going up. So we've seen a lot of retail earnings that missed. We've seen a lot of consumer sentiment that's, shifted between, positive and negative. And then at the very end of the year, with the holiday shopping season upon us, we get a bomb cyclone that comes in, right before the holiday, which really negatively impacts sales. And additionally, Southwest Airlines, it's been all over the news and Twitter and everywhere else. They basically canceled over 2,500 flights over the holiday weekend. So, just to add insult to injury, it's been a really sharp end to the year. I think this week has kind of been pretty muted. We've seen Southwest try to get things back on track, but people are still stranded. Luggage is all over the U.S., not where the passenger is. And there's going to be a lot of federal government inquiries, et cetera, into the debacle there. So more to come on that. Kind of bringing it back to stuff we focus on, the U.S., home sales. We've talked about this for the last couple of months, but pending home sales fell to the second lowest level on record. This is the second lowest since the index began in 2001. Contract signings dropped for 6 months in a row. The decline was 4% worse than estimates. There's just not a lot of good news coming from the housing market, which I think is usually a precursor for what's to come in the CRE space. And so a lot of things to unpackage over this podcast. I'm looking forward to getting into some of the discussion.
So I would add, I think I opened the podcast with low energy Manus. I should put out this disclaimer that those first 90 seconds of me wrapping up where the market is was really me talking about what I see other traders, money managers, analysts, and so forth talking about. I am certainly a glass half full guy. I think that will come through in my predictions in 2023 going forward. I don't know. Maybe it was just a few too many Christmas cookies over the last week. Maybe my arteries are just a little bit more clogged than they were a week or two ago. Maybe that's contributing to my own personal malaise, but I'm going to try to up my game for the next 35 minutes so that we can go into the new year with just, high energy Manus. How does that sound?
High energy Manus just took a sip of his latte.
That's it. I need something that just gets me going again. I can't help but say this about the Southwest thing, and I'll take a quick detour. I got some pushback last time. About 3 months ago, I had a negative remark about Southwest that I didn't like the cattle call part of it. And I got some feedback that people do love Southwest. They think it's a great airline and so forth. I don't take it very often, so my opinion is dated. But when I saw about all these problems, all I could think about was the problems were caused by, the person at the gate saying, all right, we're ready to board. Everybody trying to board at once. Nobody can get through the little hallway, and they all just start again. And then they go back in and try to go in again. And that's happening by the dozens. And before you know it, we have 7,000 flights that have to be canceled. That's just, in my own warped mind, that was the Southwest problem. It was kind of like something out of, like a B grade movie where everybody tries to go through the revolving door at once.
If only it were that simple.
That's right.
Let's take a quick look back at 2022 and cover a couple stories that stand out to us. Let's start with what pops up in terms of looking back at 22, whether it's something that is a story that we covered or possibly something that you've observed.
Well, let me start off at the macro level with the pleasant surprises, and then we'll go a little bit to the other side of it. A lot of the stories that we cover in our trading alerts, in our TreppWire, tend to look negative, not always, but I would say by probably a 2/3, 1/3 ratio. The credit stories are more negative than positive as we try to keep our clients from getting picked off and losing money on bonds for which there's publicly available knowledge about tenants leaving or so forth. But on a macro side, my pleasant surprises for 2022, the first one was ongoing resiliency of the retail market. I'm grading on a curve there for shopping malls. Certainly malls, nobody's going to give attaboys or high fives in general. But I have to say, when you look around and you see just how many underwater malls there are that are still owned by the same entity that is fighting to keep them, whether it's the Destiny in upstate New York the Palisades in Rockland, those CBL malls, Washington Prime, Preet. Not that many have changed hands, even though in many cases their value is 60 to 70% lower than it was 12 years ago or 10 years ago, give or take. The borrowers continue to fight for these. They muddle through. So that was pleasant surprise number one. Pleasant surprise number two, again, this is, I guess, grading on a scale. Given the velocity at which inflation kind of took root and the Fed had to raise interest rates so quickly and so steeply, I was pleasantly surprised that we didn't see more of a shutdown in property transaction velocity and or lending velocity, right? In 2008 to 2010, in 2015 and 16, at the very beginning of COVID, we saw the markets really clamp down. Lending was almost zero for various periods of time, especially in the CMBS market. We didn't see that over the last 6 months, which was a good sign. And then kind of on the human level, even though rate hikes have been higher, companies have been talking about cutbacks, inflation and supply chain issues have been prevalent. Unemployment has remained pretty stable at this point. It hasn't risen thus far. And at a human level, the fact that people can still count on getting jobs right now is a great thing.
Yeah, so I'd piggyback on a couple of your bullets there, Manus. I agree with you on the ongoing resiliency of the retail market. If we were hosting this podcast 2 years ago, retail apocalypse and the decline or demise of retail properties as an asset class seemed to be on everyone's radar. Coming out of the pandemic, you really saw a shift to this omni-channel type of, order online, pick up curbside, or go in the store and have a more streamlined experience. And so I think retail has been really significantly changed for the better, and stores that were not viable have closed, and the remaining stores seem to be doing pretty well. In fact, we've had just last week or within the last 10 days, Barnes & Noble announced they're going to be expanding their footprint. We've had several other stores talk about expanding their retail presence. So I agree with you. I think that's been a really good surprise for 22, even in the face of inflation and maybe a slowdown in consumer spending. So I'm hopeful that will continue into 23, although I think we're going to talk a little bit about that on our predictions. I don't know necessarily that it's going to be retail as one of the stronger asset classes into the future, just because there are a lot of challenges facing them. I would also agree on the sentiment that the market hasn't completely shut down based on unprecedented rate increases and the volatility that we saw. What I'm a little nervous about there, though, is that I think sometimes when you're in a state of uncertainty, your natural reaction is to not do anything. And so we've seen some transactions that probably were under contract. I mean, if you look at the first 6 months of 22, the lending markets were actually really good and strong. Issuance was actually on pace to exceed 21 issuance. It really wasn't until August that the market kind of slowed down. But then if you look at August to now, like you mentioned, CRE CLOs have basically dried up. We haven't seen the overall issuance that we saw through the first 6 to 8 months of the year. So maybe we're starting to see some preliminary signs of that slowing down, although I think for 22 on the whole, it's been good. And then the unemployment stuff it's good, except it also means that the Fed's probably going to have to keep pushing rates. So, it's kind of one of those things where we'd like to see a little softening there so that maybe they could stop the rate hikes. And so I think on the whole, if we're looking at 22, it's been a pretty good year. And I do think the markets have just shown how resilient CRE is as an asset class and as an investable, marketplace. People are bullish on the long-term impact of CRE and the viability. And I think we're going to continue to see that into the future, even though there's probably some tougher times ahead. The other thing I'll mention, one other, new bullet point is just, if you look at overall delinquency rates, the delinquency rate at year end is about half of what it was at this time last year. And I think if you were to put all of the ingredients in that we've talked about in 22, if we were making predictions at this time last year and said these things are going to happen, we probably would have guessed that the delinquency would be significantly higher than it was last year. And it's about half of where it is. So I think that's a pleasant surprise for 22 as well.
Well, with the good, there is sometimes the bad. And so there were some unpleasant surprises, I'm sure, that you have for the past year. What do those look like?
Well, let's go with the unpleasant, and then we're going to go back and talk about, pleasant and unpleasant at a more micro level with regard to commercial real estate and some of the stories we covered. My unpleasant surprises, I guess there'll be no real surprise. The pace at which inflation rates surge and the aggressiveness of the action needed by the Fed certainly, I think, took a lot of us by surprise. Certainly it did me. The war in the Ukraine, I think that, even though there was a lot of saber rattling in the many months going up to that, I think when the invasion began in the middle of February, I think we were all disappointed that cooler heads didn't prevail, that there was a way to avoid this. The fact that it's still going on is heartbreaking. Volatility in the energy prices, which was really driven in many ways by that war in Eastern Europe, was another surprise that was especially true early in the year, the first half of 2022. And kind of as a curveball one, after seeing last week's omnibus, another $1.7 trillion spent last week, it's just discouraging when you see, and I don't want to get political here, but it just seems that we're not preparing for a rainy day. We know that the government debt service as a function of higher rates will drive the deficit higher. We know that we've driven the deficit higher considerably over the last couple of years to deal with the COVID disruptions and displacements and so forth. At some point, I think there has to be a belt tightening to prepare the US for the next crisis. And I think sober realization of that and honest discussion in Washington would be helpful, especially when it comes to avoiding the next interest rate spike that may happen and or a deeper recession than is necessary.
Yeah, I would agree with you. I think in life, you don't want to be living paycheck to paycheck. And we kind of see that from the government now, where it's, they're raising these huge bills, exorbitant spending across who knows what. I mean, if you look at the total number of pages included in these bills and the time in which the people have to read them that actually pass and vote them through, there's no way they're actually going through all of that stuff. And, there are several topics that have been top of mind across the real estate market, like affordable housing and other things, where when you actually start parsing some of the data, if they really wanted to make some of these things an actionable item, they could use some of those funds for this. They don't allocate it for affordable housing or any of these other type of related issues. So I agree with you. I think that's an unpleasant surprise, but I don't think it's really probably not a surprise given where we've been for the last, decade or so. It's kind of what we've come to expect. And I think at some point we're going to have to reverse that and have a more long-term outlook. Interesting, the pace of the inflation and the aggressive action needed by the Fed, I think that's unpleasant because it's a side effect of what happened with COVID. And, I think what we're kind of getting ourselves into now is we're dealing with the rate increases in real time. I think we've talked about over the last 9 months, I think the Fed's raised the rate, 400 basis points. What are the downstream implications of that going to be, and how quickly are we going to feel those, just like we're now feeling the side effects of the CARES Act and some of the COVID stuff. So obviously we're dealing with that now. The markets have slowed down, but 23, maybe into 24 is where I think we probably really start to feel some of the side effects of this aggressive action. And so, how deep does that really cut? Is it more macro as the recession level, or is it, segmented by particular, property types, asset classes, geographic regions, et cetera? I think we'll be keen to see how that plays out in the upcoming, months and quarters. But overall, as it pertains to where we're at in society right now, we have so much information coming in real time that certain things just make it to where it's a tragic headline, or it's real time where people are worried about it for a couple of days or a week, and then kind of just waiting for the next headline to come. And so I think for me, that's something I think we're learning to live with now, where like the war in Ukraine, it's still ongoing, but the news media is not really talking about it like they were. The U.S. is sending aid over there, but in terms of just where it sits in terms of the hierarchy of stories, it's kind of fallen down where it's not paid as much attention to. And I think at a certain level, we've all been desensitized a little bit because we have information overload. So for me, I think that's something we just continue to live with, and hopefully we can figure out a way to manage that so that the things that are important get focused on, and the things that maybe aren't as important but drive clicks or views fade out.
My reaction to that, Lonnie, is I think you're spot on. The American populace will focus on something for 3 to 5 days, and then we move on to either the next crisis or the Super Bowl or something else, something the Kardashians said or something else, who knows? And it reminds me, sadly, of an early Simpsons episode where in the cafeteria, one of the workers is choking. And all of the workers say, oh my goodness, there's a Heimlich maneuver poster on the wall. That should inform us how to save this guy's life. So everybody runs over there and says, oh, we're going to save this guy. But right next to the poster is the softball sign up for the spring. And all of a sudden they've forgotten about the guy who's choking, and the entire cafeteria is signing up for softball, right? It does kind of feel like that when you see these headlines, that whatever the crisis is, and sadly, a lot of times it's a humanitarian crisis, something that's going on, which is really terrible. We don't have the attention span to focus on it, solve it, wrestle it to the ground, and so forth. And as a result, these problems pile up and remain unresolved. I think we need a longer attention span and a more sober conversation, and certainly less finger pointing.
While we're sober, in more ways than one, Haley did some heavy lifting for us. She dug up our top blogs, our top pods, and some of our top trading alerts as decided by you, the listener, the reader, the user. So those were the most engaged. Just to get an idea of where a lot of the interest in terms of story topics were. So let's dig into CRE and CMBS a little bit, identifying what some of the top things that were concerns for many of the investors and participants in the market.
Before we get too far, let me define what we're talking about. Obviously, if you're listening to this podcast, you already know what it is. You know that it's incredibly inexpensive and highly entertaining. We do that every week for those that are new to this. I think we have about 170 podcasts. I think we're getting about 5,000 listeners a week now, and we have 600,000 or 700,000 since the beginning of time, which is terrific. We're so humbled and honored by that. We also have a blog series, which we give out freely to anybody on our distribution list. For those that are listening that are not on the distribution list, you could just ping us here or via Twitter or via LinkedIn, and we will add you to that list. We come out with content every day, and it talks about anything from micro issues to macro issues. And then lastly, we have our morning newsletter that comes out every day at 6:30. We've been doing this since 2009, I believe. I think we're coming up on our 14th anniversary. I think we've had somewhere between 10 and 15,000 credit stories since we started doing this. In it, what we're trying to do with these is inform people that are holders of bonds or would-be holders, potential investors, of what might be a positive or negative influence on the credit of a particular bond. Sometimes it goes broader than that. Sometimes we talk about perhaps a big telephone company moving out of suburban Chicago, and that may influence the broader economy there. But a lot of it is this tenant backs $100 million loan. It's the biggest tenant. It occupies 60% of the space. They're leaving in January, and occupancy is going to fall to 40% at this huge office building in Chicago or San Francisco or New York. Those ones that are really impactful, those stories of which we do 2 or 3 a week. And those are the stories that can move the value of bonds.
I think the one thing, if you're new to the podcast, as Manus mentioned, we provide this weekly on Thursday of each week. But if you want more real-time kind of day-to-day mark-to-market analysis, credit stories, et cetera, the stuff Manus outlined is a really great resource for real-time interpretation of the market. So if you haven't signed up for our blog series or you haven't signed up for our free content, you should definitely take advantage of that, because we do have a research team focused on tracking the market at a daily granular level, where they're providing property market level commentary almost daily. And so, if you haven't taken advantage of that and you enjoy the podcast, I can assure you, you would, enjoy the blog post and the trading alert information just as much.
So running through quickly, what I saw as positives in the trading alert space and what I saw as negatives. On the positive side, I would say, going back to retail, the sheer number of times when borrowers, even with underwater assets, worked out extensions, 2, 3, 4-year extensions to extend their debt for loans that had been maturing in 22, sometimes pushing that debt out as long as 2026. We saw that with CBL and other of the big REITs out there. That was a positive. Another positive was a really significant number of hotel loans that hadn't seen payments since April or May of 2020 curing. I would say that was the second big story in the trading alert world. And then I would say, lastly, going back to the idea that the market is still functioning, the number of loans, the percentage of loans, the percentage of large loans that even in the interest rate environment we see now, paying off and refinancing on time, I would say surpassed my expectation. People that were able to muddle through, get new financing and pay off an existing loan. I would say those were the three positive stories. And I'll let you, Martha or Lonnie, react to that, and then I'll go to the negatives.
Yeah, I would agree. I think the hotel segment is one that really stands out to me. That was the property type that felt the impact of the COVID pandemic immediately, and we weren't real sure with business travel and conferences how quickly that sector could recover. And I think at this point we've seen not just a recovery, but a lot of the hotel assets are performing better in 22 than they had pre-pandemic. And to your point, there were a lot of them that used reserves and other things to kind of stay afloat during the really, slow months where there was no travel, no people staying in hotels, and they've come roaring back. So I think that's been a really positive thing. It was good to see a lot of those trading alerts come through. I think the other thing it speaks to is just, on the positive side of the trading alerts is, you mentioned it earlier, one of our pleasant surprises, man, is the resiliency of the marketplace. If you go back to the great financial crisis, when property values were diminished and the market tightened up, people just started tossing the keys back. They did not believe that there was intrinsic value in the asset or there was equity in the asset. And so they just tossed the keys back. And I think even with the immediate impacts felt by COVID, the market was a little more mature this time, and property owners and operators feel like there's still, equity available in their assets. They have been prudently managed. They've managed through the crisis and they've come out stronger. And so I think from that perspective, it's been really good. And I think, on the office side, I'm still surprised. I mean, if you just look at the office sector from a, perspective of everything they've had to endure over the last 2 years, and even to date, probably 30-40% office attendance based on the Castle systems reporting, for there to be less delinquency than there was 12 months ago, for refinances to being completed in this higher interest rate environment, I think just speaks again to the long-term resiliency of the marketplace and people's, opportunistic or bullish perspective on that sector, even in spite of some of the storm clouds brewing. So I don't know how long that could sustain, but I do think for this year, it was good seeing a number of those on the trading alerts come through as a positive.
On the negative side, some of the highest read pieces we had this year fell into 2 or 3 categories. One of the big ones was 1740 Broadway in New York. This actually was one of the highest read pieces several years in a row. A couple of years ago, we alerted our clients that the top tenant would be vacating. With a lot of our trading alerts, even though a tenant may have a lease that expires in, let's say, October 2022, it's often known a year or two beforehand that the tenant will be leaving. And that was the case for many of our trading alerts over the last couple of years, that we give people sometimes a 3 or 4 year heads up that this occupancy is going to tumble. So in 2021, the big headline was that the top 2 tenants at 1740 Broadway would be vacating. One was Davis and Gilbert, a law firm with 16% of the space, but the bigger one was L Brands with 77% of the space that they would be vacating. So between those 2 firms, 93% of the square footage in this 600,000 square foot building was going to be vacated. That was kind of the headline in 2021. The headline in 2022 was that Brookfield, which owns the property and is responsible for a $300 million loan, was going to throw in the towel on that. That was kind of a really big news item at the time. The loan remains unresolved, and Brookfield could have a change of heart that could go in a different direction. But that was one of the impactful ones in office. Other impactful ones in office related to big firms in San Francisco, New York, Chicago, and Minneapolis, not renewing space, giving back extraordinary amounts of space, subleasing their footprints. Minneapolis was particularly hard hit in that realm. San Francisco with the tech space. The Twitter story out there, even though their lease doesn't come due until 2026, the fact that the borrower could not pay off that loan this month was a very important story. So those were the kinds of things that really got people's attention this year. In the multifamily space, we had a couple big loans, one in New York, one in San Francisco, where borrowers said that they were having trouble meeting their debt service payments and or would not be able to pay off their loans. That was really unprecedented in the apartment space in the last couple of years. One was the former Lemby portfolio in San Francisco, which is now called Veritas. And the other one was in Jamaica, Queens in New York. And then the last one I would say is just how underwater some of these malls have become, the Destiny, the Palisades, and some of the others. You know, we see these new appraisals come in, we report on them almost immediately. And those were really stories that people gravitated towards, and in many cases looked to get out of bonds as quickly as they could once they realized the impact on credit enhancement due to these lower valuations. So a lot of meat there, a lot of stuff we've talked about. If you'd like an example of one of a trading alert, we'll be happy to share one with you so you can see what we're talking about. And if anything we talked about didn't really make any sense, always reach out to us via LinkedIn or Twitter, and we're happy to kind of cut through some of the noise and make a little more explainable for maybe those that are not in the capital markets.
I think one of the themes that we'll see continue to play out, if you connect the dots across our trading alerts, some of our pod stories and some of our research, is the tech sector, especially in the office space. Just in the last couple of days, CBRE came out with some stats on San Francisco office vacancy for Q4 was more than 27%. And that's alarming, especially when you look at some of the data over the last few years. And in 21, it was 19%. And in 2019, it was 3.7%. So a lot of the technology companies that have decided to go hybrid, shrink their footprint, go remote, or, shut down divisions, that's having a direct impact on office space in the San Francisco area.
There's no doubt about it. It's somewhat nuanced, I would say. The physical occupancy is dismal and the quality of life is not very good, right? What did the Times say? It's the most unlivable downtown right now, or something to that effect. I think Steph Curry was going to buy a condo. He was contracted to buy one in San Francisco. If I remember the story correctly, this is about 2 months ago. And this was, super high end, real luxury and so forth. And I think they had sold some ridiculously low number of these condos that were expected to be really sought after by tech executives and athletes and so forth. It was something like 13% had been sold or something like that. But where the nuance comes in is that the market is very big. It's not just San Francisco, it's San Jose, and it's Mountain View and the Coleman High Line and everything else. The negative part of the market is the smaller firms that may be undercapitalized. We're counting on a Series B or a Series C. They tend to sign short leases. Giving back space tends to be painful sooner rather than later. We've seen things like Zendesk and others kind of pull out of the market quickly. The positive side of the story is that for these bigger guys that are not going back to the office, the Facebooks and the Googles and the Twitters, their leases are locked in often until 2030, 2031, 2032. So even though they're physically empty, they're contractually obligated and they have deep pockets. So they won't immediately lead to default, but it could make refinancing challenging in a couple of years when these loans come due.
Yeah, I think that's the part that we haven't seen play out yet, but we're going to start seeing very quickly is if you're underwriting one of these office loans in San Francisco, as an example, and in 2019 and probably the preceding 10 years, occupancy has been 95+%. And so you stabilize your underwriting at 95% occupancy. And now for the last 2 years, occupancy has been hovering, somewhere between 80, 75%. What is stabilized market occupancy for those assets going into the future? And so sure, you have maybe large scale tech tenants with long-term lease in place, but are you really underwriting that if those leases expire sometime during your turn on a refinance? I think that's going to be the challenge for some of these. And the sublease space, I think Savills did a piece on the sublease space. just significant numbers. And it's mostly all tech driven. And it's not just San Francisco. I mean, Austin had a pretty large percentage. It was small relative to San Francisco, but Seattle impacted as well. So you have some of these top tier tech cities where there's a lot of available sublease space. So as we've talked about, one of the surprising, outcomes of 22 is the resiliency of the office market. I have to think heading into this upcoming year with so many office maturities and such instability as it pertains to, tenants taking space. I think one of the other, we didn't really talk about this as a trading alert, but if we were to go back and listen to the pod over the last 12 months, like one of the recurring themes that we've seen is the downsizing, right sizing of office tenants. And it's been really interesting over the last couple of quarters to hear some of these companies talk about how much they're saving in terms of real dollars by downsizing some of their office space. So it's a real cost cutting advantageous effort for them if they have office space they're not utilizing to downsize or right size their footprint. If they continue to shrink, interest rates stay relatively close to where they are now, there's definitely some opportunity to have some real distress that we haven't seen in a long time in the office sector upcoming.
So let's move on to predictions. And for those of you that want the full prediction write-up, we had a little fun with this. We had our team of experts that include Manis, Lonnie, Stephen Bushbaum, and Robert Jordan offer up what they felt was going to happen in the coming year for some very CRE and CMBS focused predictions, and some frivolous ones like Super Bowl picks and that sort of thing. So we're going to just give you a taste of that today because we don't have time to cover in complete detail, but look it up. It'll be a blog that we put out at the end of this week and you can dive into the details. So let's start, Manis, with some of your big picture predictions for 2023.
Yes, as I fight back from the Manis malaise of the first 90 seconds of this podcast, this is where I kind of come in glass, certainly half full. I think the first half of 2023 is bumpy, both from a broader economic front and from a CMBS front. So I do think that CMBS issuance is muted. CRE, CLO issuance is probably anemic. Asset returns are flat to modestly negative on the commercial real estate side. The rate of inflation slows and rates come down, but not as fast as we'd like. So that's the bumpiness. But I do believe, and I've said this over and over again, I believe ultimately the recession is shallow. To reiterate why, it's really strength of the financial system compared to 12 years ago, resiliency of the consumer, and relatively low unemployment rates, even at where we peak out after the Fed increases. If we stay below 5%, that's a win. And I do think we go into the second half of 2023, and I think the training wheels come off. I think we have a really, really robust recovery. I think CMBS issuance comes back, rates grind lower, spreads grind tighter, and as a result, the velocity of property sales comes back. Valuations continue to rebound from their troughs that we're going to see either late this year or early next year into maybe Q2 next year. And then inflation and higher interest rates begin to get squeezed out of the system, and even supply chains, which have been a problem for the last 2 years, continue to heal. So I do think we see something really, really positive in the second half of next year. And I'm looking forward to that time. The one caveat would be, I don't think that pertains to offices. I think left out in the cold, just like malls were for the last 5 years, will be offices. That they will be a disappointing but not catastrophic outcome in 2023.
Yeah, so I'll kind of pick up there on the office sentiment, Manis. I agree with you. I think, the one difference between office and the malls, right? We've talked a lot about how they're similar, and I do agree that they are similar. But if you look at just the sheer volume of office property, square footage relative to malls, I mean, it's significantly more. There are office buildings spread across the US at a scale not seen in the mall space. And so even if, say 70% of the office properties continue to perform and you have to have a 30%, haircut across 30% of the properties, that's going to be significant. I agree with you, not catastrophic, but I definitely think we're going to see a hard reset on basis for acquisition in the office sector for that B class secondary, tertiary located office with an atrium and, inefficient on the heating and cooling, et cetera, you're going to see a real reset on pricing. And I think that starts this upcoming year. There's just no way lenders, in my opinion, are going to continue to kick the can on those assets. If it's something that's viable into the future, has good rental rate growth prospects, there's possibility for the lender to maybe try to do workouts and stretch this along. But if you fall outside of that, struggling with occupancy, high operating expenses, secondary, tertiary market, no reposition capabilities at the asset level, I think we're going to see a really hard reset on that. I think just more broadly, I agree with you. I think if you look at 22, we had the first 6 or 8 months of really strong issuance, really strong market. Everyone was feeling pretty good coming out of the pandemic. Things have been reopened. Travel was picking back up. Hotels were occupied. Everything was, rocking and rolling. And then inflation came in and we kind of hit the brakes. I think we're going to see the reverse of that in 22, where maybe the first 6 or 8 months are kind of slow, tepid, a little bit unsure. And then maybe the last 4 or 5 months of the year, we're going to see things really pick up. So one thing I'm confident of is the market can be successful in any type of interest rate environment, whether it's low rates, high rates, whatever. Where I think investors in the market takes pause is when they're unsure of where the market's going to be. And I think that's where we've been for the last couple of months, is unprecedented rate hikes. Nobody really knows if this is going to be long-term. Is this going to be something where the Fed gets it to a certain level, they get satisfied with an inflation number and they pivot? I think once we get some certainty, and it may take the first 6 months of 23 to get there, sure, you're going to have some repricing of certain asset classes, but I think we're actually due for that. I mean, like we've said on the pod, we're about 10 or 11 years into what's generally a 7-year cycle. And so it's time for some of those assets to reset. One other thing I think is interesting, though, is Chicago in particular. I think it's a market that's going to see prolonged challenges just because we haven't seen any activity across retail, office, a lot of different sectors there. So I'm not sure if in 23 we start to see a rebound there. I do think we'll see a lot of really low traded prices on per square foot basis or total sales price for both retail and offices in Chicago, probably abnormally low relative to the overall US reset. And then I know, Martha, I don't know if you're going to go into some of these specific predictions, but I know we kind of gone through some kind of, pretty granular point in time type of vantage points.
Yeah, we do cover about 11 of these in some detail, and we've given you kind of some broad brush overall looks at these, but I'd be interested to hear delinquency predictions for next year, what that looks like.
Well, in terms of perspective, we ended the year right at about 3% overall. And the trend in 2022 was big declines in hotel and retail and negligible, if any, increase in office, multifamily, and industrial. In fact, some of those may have even gone down last year. What we are calling for, or what I'm calling for, I should say, these opinions are just my own and for the next few minutes. I think that we'll go above 4% by mid-year next year, and by the end of the year be flirting with 5%. I think that the number of loans unable to be refinanced will pile up, especially in the office space. That will push the number higher. However, negotiated loan extensions, modifications will keep the number from going significantly higher than that. Things will work out and muddle through. Hotel and retail remain resilient. Office and SASB underperform.
Yeah, I would agree. I think by year end 23, we're actually probably above 5% on the whole. And I think it's led by office. I think it's also led in part by some of these CRE, CLO, multifamily properties that we haven't seen any type of sustained cracks, but we're starting to see some of those things in certain markets where there was a lot of debt put on them. There was a reposition plan in place. They're not able to achieve those new rents, or they're not able to complete the renovations. And I think we start seeing a higher clip of those going into delinquency. And I think even some of the retail sector might see an uptick in some markets on the retail side as consumers continue to maybe, tighten the purse strings a little bit. So I think 22 was uncharacteristically low on the delinquency given everything that happened. And I think we get caught up in 23 based on what we've talked about today.
We also had a prediction about our TreppWire Podcast t-shirts, which, is a very important asset in the market.
I won't tell you whose prediction this was. I'll just go with it and you can kind of decide whose it is. The TreppWire Pod t-shirts top $300 in the secondary market. They get their own little shorthand, TWPTs, and they replace meme stocks in 2023 among retail investors as the new thing to chase. No more memes, no more NFTs. It's all TWPTs.
I love that.
Yeah, and I think we got scheduled for a podcast crew member TWPT tattoo sometime next week. So we'll see if we can actually follow through on that. But my prediction was that the TreppWire Podcast t-shirts end up at a Sotheby's auction next to a Banksy painting, and we potentially top his winning bid. So I think we're going to the top, and maybe we'll have to have some really cool post-auction, transaction. I think last time someone won one of his paintings, they ran it through the shredder or whatever and actually made it worth more. So I don't know what we do, like the shirt turns tie-dye or something when the winning bid, comes to collect the shirt.
As long as we don't get so successful that there's stories in the popular press and the tabloids about Lonnie holding out for more t-shirts, I think we'll be okay.
Instead of stock. Yeah, that won't happen. Okay, shout outs. Ken M commented on our Mortgage Universe blog piece. He had a question that we can give him an answer to. Jason J was interested in our Maturities and Mortgage Universe piece as well that we had published. Jerry W had a very nice comment. He said, thanks for another great year, TreppWire. Listening to the podcast is his Friday morning ritual. Great information. I think 2023 will be very interesting. So thanks for that very kind note. Jean KB, curious to get you guys' take on a real estate becoming a commodity story. So we'll have to dig into that a little bit and give him an answer to that. And a shout out to our analyst team of Jen S, Emily Y, Vivek D, Jack L, and Steven for powering much of the analysis and data that Trepp delivers. As far as I'm concerned, they're the hardest working team in the business. Yeah,
major kudos to that team. They continue to, outpunch their weight class. And we are all the benefactors of their hard work. I had one other shout out, Martha. Robert J reached out on LinkedIn, and we'll be getting a t-shirt sent out to him. So maybe he can help lead the charge of the secondary market trading TWPT mantra that were put out today.
Hard to say.
I mean, you'll know we'll have made it when we just have that on the t-shirt. We no longer say Trepp Pod, on the t-shirt. It's just TWPT, and it's universally known, right? Everybody knows like that's what it is, right?
Haley's
People
already ordering that right now.
Looking for.
So let's see if Haley can get that trending on Twitter this weekend. Let's see if we can get the hashtag TWPT up there on the trend rankings.
There we go.
That's it. And with that, we'll close. Thanks to our very hardworking producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have your question or comment, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
Happy New Year all. All right.